Cash flow. It is the net amount of cash and cash equivalents being transferred into and out of a business. Cash inflows show a positive figure, whereas cash outflows show a negative figure. How can we define these? Cash inflow is the amount of money going into a business, whereas cash outflow is the money going out of a business. Let's look at a few examples of cash inflows. And these represent a positive figure. Cash sales, receipts from trade, receipts from customers, sale of spare assets, and so on. Next, we're going to look into some cash outflows. So these cash outflows are payment of wages and salaries, payment of suppliers to raw materials, buying equipment, interest on bank loan or overdraft, payment of dividends, repayment of loans, payment of leasing, hire purchase rentals, and the tax that you pay to the government. These all show a negative figure in a cash flow forecast. Now let's look at an example of a cash flow forecast. You can see some information of cash inflows and outflows. In green, cash inflows, and in blue, cash outflows. Let's insert this information to a cash flow forecast given over here. Now, I'm going to enter all the cash inflows for Jan, Feb, March and April. Now let's enter all the cash outflows. Now, by finding the difference between cash inflow and outflow, we can find the net cash flow. Positive 100, take away negative 20. Therefore, you get positive 80. And this business has started in Jan, considering there isn't any opening balance. Therefore, 80 plus 0. You end up getting the answer of 80 as the closing balance for Jan. Now this closing balance appears as the opening balance for Feb. So let's find out the net cash flows for Feb, March and April. Now, time to find out the opening balance of Feb, which you derive from Jan's closing balance. Now, add the net cash flow and opening balance to find the closing balance for Feb. 200, positive 200, positive 80 gives an answer of 280. Take this 280 as opening balance to March. Now find the closing balance, negative 100 plus positive 280. Therefore, the response would be a positive 180. Take this to April as the opening balance. Now, you add 50 plus 180. Positive 50 plus positive 180 gives an answer of 230. All these are positive closing balances. Now let's look at an example where there could be a situation to gain a negative figure in the cash flow forecast. As we did before, let's enter all the cash inflows, followed by the cash outflows. Now let's find the net cash flow difference between the cash inflows and cash outflows. Plus 100 take away 20 gives a 80. Positive 300 take away 100 gives a positive 200. Positive 200 take away a negative 500 gives a negative 300. Positive 100 take away negative 200 gives a response of negative 100. Again, we assume there isn't any opening balance for Jan. 80 plus 0, 80 for Jan. Take this 80 as the opening balance for Feb. Positive 200 plus positive 80, you get a response of positive 280. Take this as the opening balance for March. Negative 300 plus positive 280, you get a negative figure, which is negative 20. Take this as the opening balance for April. Negative 100 plus negative 20, you get a response of negative 120.